When it comes to investing, people often tend to take extreme positions. They are either too cautious, putting all their money in savings accounts, fixed deposits, or gold. Or they become very aggressive, heavily investing in the stock market and equity-based mutual funds. Some even go ahead and invest a substantial portion of their portfolio in penny stocks in the hopes of making large profits in a short period. Both approaches are flawed, though in the opposite sense. So, what exactly is the right investment approach? How to build a diversified portfolio? And more importantly, how to rebalance the portfolio as per market changes. I will answer these questions for you. But, before we go ahead, I need you to press that like button, it helps with the channel's reach. Also, subscribe to the channel with notifications to never miss the latest video. With that out of the way, let's begin. Now, before we begin with our portfolio creation, let us first have a look at the options available at our disposal. What are the asset classes we have, and what are their risk versus return profiles? The first asset class we have is fixed income instruments. As the name suggests, a fixed income instrument offers a fixed return, irrespective of market condition. For example, you could opt for a fixed deposit that can pay anywhere from 6 to 8% returns before tax. Apart from FDs, there are multiple fixed instruments like PPF, National Savings Certificates, Sukanya Samriddhi accounts, and many more. Another category that people are not much aware of is bonds, both government-issued bonds and corporate bonds. The interest rate for some of the corporate bonds can be as high as 8 to 10%. Sweet, isn't it? When you do go for a corporate bond, make sure to buy from a company with a high credit rating. The Government of India also offers bonds called GSEC, currently giving a return of approximately 7.5%. The advantage of fixed income assets is very clear. The returns are protected against market volatility. However, the returns are low, and with inflation rising, it may soon be the case that keeping money in fixed income assets might lead to loss of money. The second asset class available is equity, where you can either directly invest in the stocks of the selected companies you wish to invest in, or you can opt for equity mutual funds. These are high-risk, high-return instruments, subject to market fluctuations. The volatility, however, does vary from stock to stock. Some stocks like ITC are much more stable and are referred to as defensive stocks. On the other hand, you can have stocks such as Bajaj Finance with a much higher fluctuation but also a higher growth potential. These are called aggressive stocks. I will make a separate video on stock types and how you should adjust your portfolio with a combination of defensive as well as aggressive stocks. Now, within equities, there are multiple options, like small cap, mid cap, and large cap. Then there are sectoral options like the banking sector, FMCG, IT, manufacturing, and many more. You can also invest in foreign markets like the US, and also Russia, where recently it was announced that you can directly invest with Indian currency. The third asset class is real estate. Although real estate is a great asset class, it is not for everyone. The initial costs could be very high. Another issue is with liquidity. Real estate can be a headache to sell. Unlike stocks, the liquidity is very low. So, you can always go into real estate when you feel you have accumulated enough capital, and have enough stashed in other asset classes as well. These days, however, investors have another great option at their disposal called REITs, that is, Real Estate Investment Trusts. It works like a mutual fund, wherein it pools capital from investors and invests that money into real estate projects. Investors can earn dividends from these, without buying or managing the properties themselves. The fourth asset class is gold. I have explained the advantages of gold investment and associated attributes in a separate video. Also, why physical gold is not a good investment option. If you haven't watched the video, the link would be in the description below. Do check it out. One small thing about gold investment is, it is not a very good wealth creation instrument. The returns are just above the inflation rate. Gold is a good hedging instrument and should be used accordingly. So, now that we have discussed the basic asset classes, it's time to answer the question, how to build a diversified portfolio. First of all, when it comes to investments, there are no such things as one size fits all. A lot of factors come into play, such as your vision, the capital you have, the risk you can undertake, your expertise or lack of it, and many more. Your vision or financial goal determines the investment type and intensity. Your goal may be to buy a house, buy a new car, or save for early retirement. The first thing you need to do is identify your financial goal and accordingly select the asset class. For example, if you foresee an expense like marriage in 2 to 3 years, then highly volatile asset classes might not be the best option. In that case, a fixed income return instrument could serve your needs. If you have a long-term goal, then of course equity investments are much preferred. Another aspect to consider is your risk appetite. The stock market can have drastic falls, and not everyone has the risk appetite for such swings in the market. So, before you decide to put your money in any asset class, you must thoroughly understand the associated risks and then determine whether you are in a position to take the risk or not. Now, people in their late 20s or 30s have more than one financial goal, which could be buying a house, buying a car, children's education, retirement planning, and so on. What they need is a diversified portfolio. If I were to give my example, as a man in his late 20s, I too have multiple goals, like buying a house, a new car, planning for early retirement, and some money as emergency funds. If you wish to know my investment strategy, do comment below, and I will make a separate video on that. But, for people with multiple goals, there has to be a combination of multiple asset classes in the portfolio. An example, 60% in equity instruments, both stocks and mutual funds, 30% in fixed income instruments like bonds to take off immediate needs, and lastly, 10% in gold and crypto. This is a rough estimate of the portfolio diversification for someone in their late 20s and 30s. Let us now see what portfolio rebalancing is, and why it is so important. Portfolio rebalancing is the art of changing the percentage allocations of different asset classes as per the changing macroeconomic situations. According to the book, The Intelligent Investor, by Benjamin Graham, your investment portfolio should be an equal combination of fixed income instruments and equity instruments, 50:50. You can adjust the equity portion and keep on rebalancing according to stock market valuation. For example, if the stock market becomes expensive, you can reduce your exposure to the stock market and simultaneously increase it in fixed income instruments. A question then pops: how will you get to know whether the stock market is expensive or cheap? You do so by observing the pay ratio of Nifty. Generally, the ratio hovers between 20 and 25, anything greater than 25 is considered expensive, and similarly, anything less than 20 is considered cheap. Apart from this, you also need to keep your eye on the economic factors, at least the basic ones like inflation, interest rates, oil prices, etc. No need to get overwhelmed, you will learn all this with time and practice. There is no need to panic. You must start learning from today itself, so you can give yourself enough time to understand the nuances, and a few months in you will be in a comfortable position. So, today we learned about different asset classes that we can invest in, then we saw how one should diversify their portfolio based on their situation. Primarily, the financial goals and the risk appetite. And finally, we saw why portfolio rebalancing is important and how we should proceed with it. This brings us to the end of the video. If you enjoyed the video, make sure to subscribe to the channel. Take care of yourselves and your families. God bless us all. Thank you.